Welcome to Kudlar Invest channel. Investors should be prepared for Alibaba's split. Alibaba is pushing ahead with its grandiose plan to transform itself from a sprawling conglomerate into a holding company. The Chinese tech giant confirmed on Thursday that it will spin off its cloud division and detailed plans to bring other divisions to market. Alibaba said its board approved the spin-off of the company's cloud division into an independent, publicly traded company that will include an artificial intelligence (AI) division. The group added that it will begin the process of external financing of its global e-commerce division, is exploring an initial public offering (IPO) of its smart logistics division, and will conduct an IPO of one division of its core Chinese food business. "We are taking concrete steps to unlock the value of our business," said Daniel Zhang, chairman and CEO of Alibaba. Earlier this year, Alibaba announced the largest restructuring in its history, seeking to unlock shareholder value through a spin-off into 6 divisions. It is also meant to boost market competitiveness, in response to complaints from regulators that have been hitting the Chinese tech sector since late 2020. In transitioning to a holding company structure, Alibaba also established a board-level wealth management committee tasked with raising the value of equity capital. Alibaba is committed to increasing shareholder returns by implementing a sound capital allocation system, said Toby Xu, Group Chief Financial Officer. Thursday's news, which also included information about the directors and CEOs of the new business groups, marks a major update in Alibaba's corporate transformation. The company also released quarterly results showing disappointing sales amid difficult macroeconomic conditions in China. Alibaba reported earnings of $1.56 per share on sales of $30.32 billion in the first 3 months of 2023, the group's fourth fiscal quarter. Analysts polled by FactSet had expected earnings of $1.36 per share and sales that were slightly above reality. Alibaba shares fell slightly yesterday on the back of these reports. Revenue for the cloud division, which rivaled ChatGPT and artificial intelligence, also disappointed, falling 2% year-on-year to $2.71 billion, short of analysts' expectations of $2.83 billion. However, Alibaba investors are optimistic about the future of the cloud business and especially the prospect of realizing a higher market value when the division is eventually listed independently. "This unlocks tremendous shareholder value," said Thomas Hayes, chairman of Great Hill Capital, which owns a stake in Alibaba. "In a few years, this division will be more valuable than the company's entire market cap today." Hayes said owning Alibaba's cloud business would be akin to owning Amazon Web Services, AWS, from Amazon.com, AMZN. It is the cloud computing division that spun off from Amazon in 2016. General earnings news was not as optimistic. China's mainstream e-commerce revenue fell 3% year-over-year to $19.81 billion and came in below Wall Street's expectations, the latest signal of weaker domestic demand in the world's second-largest economy. The strength of consumers in China has received renewed attention in recent weeks amid growing fears of global growth. These worries, which weighed on commodity prices and dampened investor sentiment in Asia and around the world, were fueled in part by Chinese data showing a worsening domestic picture as well as weaker external demand for commodities. China's viability to recover in 2023 after the slowdown caused by lockdowns in 2022 remains a key topic in global markets, with trends in Alibaba's financial performance taking the lead. But at least on Thursday, all eyes seem to be on the latest news about the Alibaba partition, and perhaps for good reason. Company valuation. Despite the serious decline, now the company does not look cheap. The PE ratio is within 50. Yes, there are analysts' expectations of a sharp improvement in profitability, hence the forward PE is already below 10, but this is another grandmother said for 2. Total flows remain rather stagnant, hence the assessment should be as conservative as possible now plus premium for regional risk. Forward revenue growth rate less than 10%. I understand that her flows are not very stable now and it is not entirely correct to apply discounting, but rough calculations show that with an income growth rate of around 10% in the next 5 years, the current estimate is clearly overstated. Technical outlook. Technically, the picture is still very sad. After the impulse of the bears, the price was able to rebound only within the framework of the flat. In my opinion, we could see significant downward movement in a recessionary scenario, as the company operates in sectors that are highly sensitive to the state of the business cycle. My opinion. Unfortunately, I have this company in my portfolio. Thank God, the position is very small, within 1% of the deposit. I will continue to keep it until better times. Apparently, I'm definitely not going to increase it. Thank you for watching. Subscribe.